Hello and welcome to Boni's Life. Hello and welcome back to Boni's Life, the channel where we cut through the noise and give you the signal. If you've opened your portfolio recently and felt a sensation similar to looking into the fridge, expecting a gourmet meal and finding only a single questionable olive, then this episode is for you. The crypto market has been, to put it mildly, a roller coaster. A roller coaster designed by a sadist, perhaps, but a roller coaster nonetheless. We've seen dizzying highs that felt like they'd never end, and now we're navigating a downturn that has many wondering if the party is over for good. But here's the secret the pros know. Every market, whether it's screaming upwards or plummeting downwards, is a market of opportunity. The key is knowing what kind of market you're in and how to trade it. A strategy that made you a genius in a bull run can make you a pauper in a bear market. So today, we are going to do a deep intellectual dive into the current state of the crypto world. We're going to dissect it, analyze it, and by the end of this episode, you will have a clear, actionable framework for how to trade these conditions. Whether you're a long-term investor planning for generational wealth, a mid-term swing trader catching the waves, or a short-term trader dancing between the raindrops, we'll be looking at everything: the big picture macroeconomic forces, the nitty-gritty of on-chain data, and the technical setups that are screaming at us from the charts. We'll identify the exact type of market we are in right now based on hard data, not hype. And most importantly, we'll translate all of this complex information into concrete strategies and trade triggers. So grab your coffee, silence your notifications, and let's get smarter. All right, let's get our hands dirty. Before we can talk about where we're going, we need to have an unflinching look at where we are. As of today, February 12th, 2026, the crypto market is not for the faint of heart. The total cryptocurrency market capitalization is hovering around $2.33 trillion. Now, that sounds like a massive number. And it is, but it's a shadow of its former self. We've seen a staggering $2 trillion wiped off the market since the peak in early October 2025. That's not a dip, that's a seismic shift. Bitcoin, our digital king, is trading at approximately $65,800. This is after a brutal 52% correction from its all-time high of over $126,000 just a few months ago. Let that sink in. A 52% haircut. If your baba was that aggressive, you'd be suing for emotional distress. So, what type of market are we in? Let's call it what it is. We are in a deep bear market correction. This isn't a garden variety pullback. This is a prolonged period of negative sentiment, price depreciation, and investor fear. The data screams it from the rooftops. When an asset like Bitcoin is trading nearly 50% below its all-time high and has been in a downtrend for months, you are not in Kansas anymore, Dorothy. You are in bear country. But don't be scared. Bears can be tamed. Or more accurately, their movements can be predicted and traded. To do that, we need to look beyond just the price. We need to become market detectives, looking at the clues the market leaves behind. We'll focus on 5 key indicators today. Volume, total market capitalization, the Fear and Greed Index, open interest, and liquidations. These are the instruments in our orchestra, and together, they play the symphony of the market. First, let's talk about volume. Think of trading volume as the energy or the enthusiasm of the market. High volume in an uptrend is confirmation. It shows strong conviction from buyers. High volume in a downtrend shows panic and capitulation. But what does low volume mean? Right now, the 24-hour trading volume for Bitcoin is around $41 billion, and the total crypto market volume is about $111 billion. More telling is the trend. Spot volumes on major exchanges are down approximately 30% since late 2025. This is what we call the sound of silence. The market is exhausted. The panic sellers have mostly sold, and the enthusiastic buyers are sitting on the sidelines waiting for a clearer signal. This low-volume environment is characteristic of a bear market consolidation. It tells us the market is catching its breath. But it also means that any significant move, up or down, can be exaggerated because there isn't enough liquidity to absorb large orders. It's like a whisper in a library. It sounds much louder than it actually is. This is a crucial piece of information for traders, as it signals a higher risk of volatility and sharp, sudden price swings. Next, we look at the total market capitalization or total cap. We've already established it's at $2.33 trillion, down from a peak of over $4.3 trillion. This chart is the 30,000-foot view of the entire crypto economy. What it shows us is a massive contraction. Capital has fled the market. This isn't just Bitcoin taking a hit, it's a systemic deleveraging across the board. Altcoins, which are more speculative, have been hit even harder. We see Ethereum, the queen of crypto, struggling to hold the $1,800 to $2,000 level after being decisively rejected at $2,100. Other former high flyers like Solana are trading in a tight range, around $80. The shrinking total market cap is the clearest sign of a bear market. It reflects the loss of confidence and the re-evaluation of risk by investors, from large institutions to retail traders. For a new bull cycle to begin, we need to see this trend reverse. We need to see capital flowing back into the ecosystem, pushing the total market cap back up through key resistance levels. Until then, we are in a defensive environment. Now for one of my favorite sentiment indicators, the Crypto Fear and Greed Index. This tool measures market sentiment on a scale from 0, extreme fear, to 100, extreme greed. Where are we now? We are wallowing in the gutter of extreme fear, with readings between 5 and 8. This is the lowest level we've seen since the COVID-19 crash in March 2020. This is a market that is terrified. Everyone is expecting the next leg down. Now, here's the contrarian part and why I love this indicator. As the legendary investor Warren Buffett said, be fearful when others are greedy, and greedy when others are fearful. An extreme fear reading is often a powerful buy signal for long-term investors. It signals that the market has priced in the absolute worst-case scenario, and that we are closer to a bottom than a top. It doesn't mean we can't go lower, but it suggests that the risk-reward ratio is starting to skew heavily in favor of the bulls. For short-term traders, it's a warning of potential high volatility and sharp bounces, as even a little bit of good news can trigger a significant relief rally in a market this fearful. Let's move to the derivatives market and look at open interest. Open interest represents the total number of outstanding derivative contracts, like futures or options, that have not been settled. It's a measure of the total amount of money in the derivatives market. Currently, Bitcoin's open interest is sitting at around $45 billion, its lowest level since November 2024. What does this tell us? It tells us that a massive amount of leverage has been flushed out of the system. The speculative froth has been blown off the top. This is what analysts mean when they say this has been an orderly deleveraging. The gamblers who were making highly leveraged bets on the price going up have been wiped out. This is a healthy and necessary process for a market bottom to form. A lower open interest means the market is less susceptible to cascading liquidations and is building a more solid foundation. It's like a forest fire that has cleared out all the dead wood, allowing for new, healthy growth to emerge. We are in that cleared out forest right now. Finally, let's talk about liquidations. This is the brutal, bloody side of the derivatives market. A liquidation is when a trader's position is automatically closed by the exchange because they can no longer meet the margin requirements. In simple terms, they've lost their bet and the house takes their money. In the past 24 hours, we've seen $342 million in liquidations, a relatively even split between longs and shorts. But looking back at the major drops like the one on February 5th, we saw over $1 billion in Bitcoin positions liquidated in a single day. These liquidation cascades are what caused the dramatic, gut-wrenching price drops. The good news, as we saw with the declining open interest, is that the fuel for these massive liquidation events is diminishing. However, there is still significant risk. CoinGlass data shows there is a cluster of about $675 million in long liquidation pressure just below the $65,000 level for Bitcoin. This means if the price dips below that level, it could trigger another cascade of selling. This is a critical level for traders to watch. It's a line in the sand between holding the current range and potentially exploring lower lows. Now, it's easy to get lost in the crypto-specific data, but it's critically important to remember that crypto does not exist in a vacuum. It's part of a larger global financial system. and it's being buffeted by the same storms as the stock market, bonds, and commodities. To truly understand the current market, we have to zoom out and look at the macroeconomic picture. And frankly, the picture is looking a bit gloomy. First, let's talk about the elephant in the room, the Federal Reserve. The Fed's policies are the tide that lifts or sinks all speculative assets, and the tide is going out. We have a new Fed chair nominee, Kevin Walsh, who is widely considered to be a hawk. A hawk, in central bank terms, is someone who favors tighter monetary policy to control inflation. This means potentially higher interest rates and, crucially, a shrinking of the Fed's balance sheet. For the past several years, crypto has been a massive beneficiary of the Fed's money printer going brrr. That fire hose of liquidity fueled the last bull run. A hawkish Fed turning off the spigot is a major headwind for crypto. This isn't speculation, it's cause and effect. As Julius Bayer's research team noted, a smaller balance sheet is not going to provide any tailwinds for crypto. Compounding this is the recent US jobs report, which came in much stronger than expected. While good news for the economy, it's bad news for markets hoping for a quick pivot to lower interest rates. A strong economy gives the Fed more room to keep rates higher for longer to combat inflation. The market had been pricing in a potential rate cut in March, but those hopes have been thoroughly dashed. The current Fed funds rate is at 3.5%, and the consensus is now that we won't see a cut until at least the middle of the year, if not later. Higher interest rates make safe, boring government bonds more attractive, pulling capital away from risky assets like crypto. Then we have the specter of trade wars and tariffs. The Trump administration's policies saw the average tariff rate on US imports jump from 2.6% to 13% in 2025. These tariffs create economic uncertainty and can disrupt global supply chains, which dampens investor sentiment and pushes them towards safety and away from risk. And if that wasn't enough, we're seeing a significant sell-off in the broader tech sector. The Nasdaq is at a 2-month low, and the AI-fueled hype that helped lift all tech-related boats, including crypto, is coming under serious pressure. When the big dogs of the stock market are getting hit, crypto is going to feel the pain. It's all connected. The massive outflows from institutional Bitcoin ETFs, over $3 billion in January alone according to Deutsche Bank, are a direct reflection of this risk-off sentiment. Traditional investors are getting spooked by the macro environment and are pulling their money out. This is a global deleveraging event, and crypto is right in the middle of it. So we've diagnosed the patient. It's a bear market suffering from a nasty case of macroeconomic headwinds. The patient is weak, fearful, and prone to sudden movements. So what's the prescription? How do we trade this? The answer depends entirely on who you are as a trader. The strategy for a long-term investor is radically different from that of a day trader. So let's break it down. Here is your playbook, tailored for your specific time frame. But if you are a long-term investor with a time horizon of 3 to 5 years or more, this is your time to shine. This is where fortunes are made. Your mantra is simple: accumulate. You are not trying to time the exact bottom. That's a fool's errand. You are taking advantage of the fear and panic of others to buy world-class assets at a significant discount. The fear and greed index at 5 is not a warning for you. It's a screaming buy signal. Your primary strategy is dollar cost averaging. You should be deploying capital systematically at regular intervals. Every week, every 2 weeks, or every month, you buy a fixed dollar amount of your chosen assets, regardless of the price. This strategy takes the emotion out of investing and ensures you buy more coins when the price is low and fewer when the price is high. You are not looking for a quick flip. You are building a position for the next bull cycle. Your prime buying zone for Bitcoin is between $60,000 and $65,000. This is a major support area, backed by the 200-day moving average at around $62,400. Any dip into this zone is a gift. Watch the 200-week moving average. Historically, buying Bitcoin at or near its 200-week moving average has been the most profitable long-term entry point. While we are not there yet, it is a level to keep in the back of your mind as your ultimate back-up-the-truck buy zone. Use the Weekly Relative Strength Index, RSI. When the weekly RSI dips into the oversold territory below 30, it has historically marked the best buying opportunities for a new cycle. We are approaching these levels now. Focus on quality. This is not the time to be gambling on speculative, low-cap altcoins. Stick to the blue chips of the crypto world: Bitcoin, BTC, and Ethereum ETH. These are the assets with the strongest network effects, the most developer activity, and the highest institutional adoption. They are the most likely to survive the winter and thrive in the spring. You can have a smaller allocation to other promising layer ones like Solana, SOL, but the core of your long-term portfolio should be BTC and ETH. Your greatest asset is your patience. You are a crocodile, waiting silently in the water for the perfect moment. You ignore the daily noise. You understand that bear markets are a feature, not a bug, of the crypto cycle. You are buying time as much as you are buying assets, and time is on your side. If you are a swing trader with a time horizon of a few weeks to a few months, your job is more complex. You are not just accumulating, you are trying to catch the significant swings within the broader bear market trend. These are the relief rallies and the subsequent legs down. Your goal is to profit from the volatility. In a bear market, prices often get stuck in a range for extended periods. Your job is to identify this range and trade it. You buy at the bottom of the range, support, and sell at the top of the range, resistance. You also need to be a trend follower. The primary trend is down. This means you should be looking for opportunities to short the market at key resistance levels. And Bitcoin is currently trading in a range between roughly $60,000 and $70,000. The bottom of the range is your buy zone, and the top is your sell/short zone. A break below $60,000 would signal a move to the next support level, likely around $52,000. A break above $70,000 and especially above the resistance at $72,500 would signal a stronger relief rally, with a target of around $80,000. The 50-day moving average, currently at $67,200, is your key resistance level. In a bear market, the 50-day MA often acts as a ceiling. A rejection from this level is a high probability short signal. Conversely, a sustained break above the 50-day MA would be a bullish sign for the medium term. Look for bullish and bearish divergences on the daily RSI. A bullish divergence is when the price makes a new low, but the RSI makes a higher low. This can signal a potential bounce. A bearish divergence is the opposite and can signal a potential drop. Look for a bounce off the support at $60,000 to $62,000. Enter a long position with a stop loss just below the range low. Your target would be the top of the range, around $67,000 to $70,000. Look for a rejection from the resistance at the 50-day MA, $67,200, or the top of the range, $70,000. Enter a short position with a stop loss just above the resistance level. Your target would be the bottom of the range, around $62,000. You are a surfer. You are not trying to control the ocean. You are just trying to ride the waves. You are nimble and flexible. You are not married to any position. You take profits when you have them, and you cut losses quickly. You respect the power of the primary trend, which is down. You understand that in a bear market, cash is a position. If you are a short-term trader or a day trader, you are operating on the smallest of time frames from minutes to hours. You are a scalper looking to make small, consistent profits from the market's noise. You thrive on volatility. A bear market can be a paradise for you, as it often brings the wild swings you need to be profitable. You are looking for small, quick moves. You are trading based on order flow, liquidity levels, and intraday technical patterns. You are using leverage, but you are also using tight stop losses. Your goal is to get in, get your profit, and get out. You are constantly watching the liquidation heat maps on platforms like CoinGlass. You know that price is often drawn to areas of high liquidity. That $675 million in long liquidation pressure below $65,000 is a magnet for price. You can look to short the market on a weak bounce, targeting that liquidation zone. You watch the funding rates in the perpetual swaps market. When funding rates are highly positive, it means longs are paying shorts, and the market is over-leveraged to the long side. This can be a good opportunity to look for a short scalp. When funding rates are negative, it can be a good time to look for a long scalp. You are a master of the 1 hour, 15-minute, and even 5-minute charts. You are looking for classic patterns like flags, pennants, and head and shoulders to give you entry and exit signals. On a weak bounce to an intraday resistance level, like $66,500, you could enter a short position with a very tight stop loss at $66,700. Your target would be a quick move down to $66,000 or even $65,800. If the price sweeps a key low and takes out liquidity, and you see a strong bullish reaction on the lower time frames, you could enter a quick long position, targeting the next area of intraday resistance. You are a hummingbird. You are fast, agile, and you don't stay in one place for long. You are disciplined and unemotional. You have a strict risk management plan and you stick to it religiously. You understand that you will have many small losses, but your goal is to have your small wins outweigh them. You are not trying to predict the future. You are just reacting to the price action in the present moment. So there you have it. A comprehensive breakdown of the current crypto market and a playbook for how to trade it. Yes, we are in a bear market. Yes, there is fear and uncertainty. But as we've seen, within this chaos lies immense opportunity. For the long-term investor, it's the sale of a lifetime. For the swing trader, it's a volatile playground. And for the scalper, it's a target-rich environment. The key is to know yourself. Be honest about your time horizon, your risk tolerance, and your level of expertise. Choose the strategy that fits you and execute it with discipline. The market doesn't care about your hopes or your fears. It only rewards those who have a plan and stick to it. Thank you for joining me on this deep dive. If you found this analysis valuable, do me a favor and hit that like button, subscribe to Boni's Life, and share this video with someone who needs to hear it. The more we educate ourselves, the stronger we become as a community. Stay safe, trade smart, and I'll see you in the next episode.